Hello everyone, welcome to EduTap and welcome to the Finance 360-degree sessions in which we cover the relevant and important finance current affairs, RBI notifications, RBI press releases. Today I have brought for you a very important RBI notification, RBI press release for you. That is, the Reserve Bank of India has released the Prompt Corrective Action Framework for the urban cooperative banks. So if you are preparing for the RBI Grade B examination, you must know that how important the Prompt Corrective Action Framework is for any organization. Okay, so the Prompt Corrective Action Framework, this was applicable for the scheduled commercial banks. Then later on, the Prompt Corrective Action Framework was brought for the NBFCs in 2022. Now the Prompt Corrective Action Framework has been brought for the urban cooperative banks, and in the previous years of the RBI Grade B, we have seen direct questions from the Prompt Corrective Action Framework. So it is very, very important. And why it has been brought for the urban cooperative banks? What is the norms for the urban cooperative banks under the Prompt Corrective Action Framework? What are the different criteria that we are going to discuss in today's session? We will have the clarity about this Prompt Corrective Action Framework for the urban cooperative banks, the criteria, the norms and everything. So this is going to be a very, very important session directly from the examination point of view of RBI Grade B, and we will discuss it in length we will discuss this in detail. So let's start with the session. Good morning everyone. Good to see all of you in the session. Now, before starting with the session, do subscribe to the YouTube channel of EduTap to continue getting these videos, as well as join our Telegram channel so that you can get the PDF of the session in this Telegram channel of EduTap, and the link of the Telegram channel is provided in the description box below. So let's start with the Prompt Corrective Action Framework for the urban cooperative banks. Okay, so the Reserve Bank of India has issued the PCA framework for the urban cooperative banks to identify the urban cooperative banks that are getting weaker or that are having the weak financial health. So the urban cooperative banks that are having the weak financial health, that are getting under the stress situation, they are not able to maintain the good capital with themselves, or the urban cooperative banks that are not able to have profits, or they are having lots of non-performing asset. So to identify such urban cooperative banks that are having the weak financial health, the Prompt Corrective Action Framework will be used, and this will bring the timely steps for the improvement of the weak urban cooperative banks. So under the Prompt Corrective Action Framework, there will be identification of the weak urban cooperative banks, and under the prompt corrective action, that prompt, in the prompt manner, you have to take the corrective action to get your urban cooperative bank into the healthy status. Okay, so that is the basic idea, that identify the weak urban cooperative banks and then take the corrective measures, then take the corrective actions to make this urban cooperative bank healthy again, to have the healthy financial status. Okay. So next is, so Prompt Corrective Action Framework for the urban cooperative banks. The objective of this framework is to enable the supervisory intervention at an appropriate time. So first, identify the urban cooperative banks that are weak, that are having the stressed health, or that are having the weak financial health. Okay, and then after the identification of the urban cooperative banks under the PCA framework, there will be the supervisory intervention that will be done by the Reserve Bank of India at the appropriate time, and require the urban cooperative banks to initiate and implement the remedial measures in a timely manner, so that the urban cooperative banks can restore their financial health, can again become healthy in terms of their financial status. I hope this is very easy to understand, that Prompt Corrective Action Framework is for the health of the urban cooperative banks, so that the urban cooperative banks can take the remedial measures so that they can again become healthy. Okay, so this Prompt Corrective Action Framework for the urban cooperative banks, this will become effective from April 1st, 2025. That is from the next year. This Prompt Corrective Action Framework is going to become effective on the urban cooperative banks. Okay, so now the PCA framework shall be applicable to all the urban cooperative banks that are under the Tier 2, Tier 3 and Tier 4. So there are the Tier 1 urban cooperative banks, Tier 2, Tier 3 and Tier 4 urban cooperative banks. So Tier 1 urban cooperative banks are very small urban cooperative banks. They are the unit urban cooperative banks and the salary earner UCBs, or the UCBs that have the deposit size of up to 100 crores, that is less than up to 100 crores, less than or equal to 100 crores. Okay, Tier 2 UCBs are a little bigger than the tier 1 UCBs. Tier 2 UCBs have the deposit more than, they have the deposit size of more than 100 crores up to 1000 crores. So these are the tier 2 UCBs. Then tier 3 UCBs are a little bigger than the tier 2 ones. They have the deposit size of more than 1000 crores up to 10,000 crores. Then there is the tier 4 urban cooperative banks that are the biggest urban cooperative banks. They have the deposit size of more than 10,000 crores. So the PCA framework will be applicable to all the urban cooperative banks that are under the tier 2, tier 3 and tier 4. Okay, except the urban cooperative banks under the all-inclusive directions. So there are some urban cooperative banks, okay, there are some urban cooperative banks that are under the all-inclusive directions. All-inclusive directions means very strict directions of the Reserve Bank of India, that you cannot take more deposits, you cannot do more lending, and such kind of strict directions from the RBI. So if a urban cooperative bank is, let's say, a tier 2 urban cooperative bank, and this UCB is under the all-inclusive direction, so for the time being it will not come under the PCA framework, because already the RBI is following very strict directions for this UCB. Okay, so urban cooperative banks under the all-inclusive directions shall continue to be monitored under the conditions of the AID only. A suitable transition time has to be seen that shall be provided to such urban cooperative banks for compliance with the provisions of the PCA framework as and when these come out of AID. So until the UCBs are under the AID, under the all-inclusive directions, they will remain under the conditions of AID only. When they come out of the AID, when they come out of this all-inclusive directions, very strict directions of the Reserve Bank of India, then they will get a timeline that within which time period they have to start following the PCA norms. Is it clear? Is it clear? Any confusion till now? Now tier 1 UCBs, they are not covered under the PCA framework because it is only for the tier 2, 3, 4 urban cooperative banks other than the all-inclusive directions ones. Shall be subject. So tier 1 UCBs, they are not covered under the PCA framework, but they will be subject to enhanced monitoring under the extant supervisory framework. So currently there was the supervisory framework. So under the supervisory framework, the tier 1 UCBs will be under greater monitoring. Okay, and the exemption of the tier 1 UCBs from the PCA framework shall be reviewed in due course. That should we bring this tier 1 UCBs also under the PCA framework. Okay, so this is the whole idea, that the PCA framework is the prompt corrective action framework in which the RBI is identifying the weak urban cooperative banks and RBI is telling them to take the remedial actions, to implement the remedial actions. The RBI is also taking supervisory actions on this weak UCBs so that they can become strong again, so that they can become healthy again. Okay, so for now tier 2 to tier 4 UCBs are under the PCA framework. They can come under the PCA framework if they are under the stress. They can come under the PCA framework other than the all urban cooperative banks that are under all-inclusive direction, because already they are under the all-inclusive direction. Tier 1 UCBs they cannot be covered under the PCA framework for now. But it has been said that later on the RBI is trying to see that should we bring the tier 1 UCBs also under the PCA framework. Okay, so what are the norms, what are the criteria of the PCA framework, that we will understand. Okay, so first of all, which urban cooperative banks are weak urban cooperative banks? Which urban cooperative banks are under the stress? How do we identify such urban cooperative banks? How do RBI identify such urban cooperative banks? So RBI has said that there are 3 indicators to identify that which urban cooperative banks are weak or are under the stress. So that is capital, asset quality and profitability are the three key areas, are the 3 key indicators for monitoring in the revised PCA framework. That is, simply the idea is that these are the 3 indicators according to which if you are not following the norms of these 3 indicators, that means you are weak, that means you are under the stress and you will be brought under the PCA framework. You will have to follow the higher supervisory actions, you will have to implement the remedial measures. That is the basic idea. Okay, so for the capital indicators to be tracked, for the capital, asset quality and profitability. For the capital there is CRAR, for the asset quality there is the net NPA ratio, net non-performing asset ratio, and for the profitability there is the net profit. Okay, so these are the indicators through which you can, or these are the parameters through which you can identify the urban cooperative banks that are under the stress, So first of all, CRAR. What is CRAR? So that is the capital that a bank is maintaining against the risk weighted asset. So asset of a bank, urban cooperative banks are giving the loans, right? They are giving the loans. Urban cooperative banks, they are giving the loans. Okay, so the loans that they are giving, they are earning interest on these loans. So these are the asset of the urban cooperative banks. But when the urban cooperative banks, when the UCBs are giving the loans, there is some risk attached to that loan, that what if that loan doesn't come back? So when the UCBs are giving the loans, they are the asset of the UCBs, but there is some risk weight that is attached with the asset. Okay, so let's say the risk weighted assets are of 100 crores. So the capital that has to be maintained, let's say capital is 12%. So that means 12 crores of the capital has to be maintained by the urban cooperative banks. Okay, for the tier 1 UCBs, the minimum CRAR requirement as per the Reserve Bank of India is 9% of the risk weighted asset. That means for the tier 1 UCBs, if they have the 50 crores, of the risk weighted asset, they have to keep 9%. They have to keep 9% of this 50 crores as the capital. Okay. Next, tier 2 to tier 4 UCBs have to keep minimum of 12%. They have to keep tier 2 to 4 UCBs, they have to keep 12% of the capital to risk weighted asset ratio. That means they have to keep 12%, 12 crores out of the 100 crores. So for tier 2 to tier 4 UCBs, the minimum CRAR, the minimum capital that they have to maintain is 12% of the risk weighted assets on an ongoing basis. But you have to remember that, see, the urban cooperative banks are divided into tier 4 tiers. Now before, like a few years before, there was no categorization of the urban cooperative banks. This is quite new. So before, all the urban cooperative banks, they all were having the CRAR requirement of 9%. So now when the urban cooperative banks were divided into different layers, it was said that the tier 2 to tier 4 UCBs, that means these UCBs will have to maintain the minimum CRAR of 12%. But all of these UCBs were actually maintaining 9% of CRAR. So the RBI said that do not worry, we will give you time. That is, UCBs in tier 2 to tier 4 which do not currently have the 12% of the CRAR shall achieve the same in a phased manner. Such UCBs shall achieve the CRAR of at least 10% by March 31st, 2024. That means they must have achieved this CRAR because March 31st, 2024 has passed. Next, 11% by March 31st, 2025 and 12% by March 31st, 2026. That means all these UCBs, tier 2 to tier 4 UCBs, all these UCBs have to achieve the CRAR of 12% by March 31st, 2026. Got it? Got the idea? Any confusion here? Anyone? Till now, any confusion? There are nearly 40 students here. All of you, the idea is clear? Yes or no? Just tell me. Then only I will be able to move forward if you have understood the idea. Have you understood the idea? So this is tier 2 to tier 4 UCBs have to maintain the CRAR of 12%, but the timeline has been given to them that by 2026 they can achieve the CRAR of 12%. Clear? Only 2 students, Priya and Yogesh. What about the others? Clear? Nice, very good. So CRAR minimum regulatory requirement. CRAR minimum regulatory requirement for now is 10%. Remember this. But because by March 31st, 2024, they must have achieved the minimum CRAR of 10%. So by March 31st, 2024, the minimum CRAR requirement is how much? It is 10%. By March 31st, 2025, the minimum CRAR requirement will become 11%. That's why the CRAR is not directly mentioned here, because RBI knows that these guidelines are going to work for 10 years, 20 years. And within that timeline, the CRAR is going to change for the tier 2 to tier 4 UCBs. So for now, the CRAR minimum regulatory requirement of the CRAR is 10% for the tier 2 to tier 4 UCBs for now till 2025. So this is the indicator of the CRAR for the tier 2 to tier 4. If they are maintaining this minimum CRAR, that means they are very healthy. That means they are very healthy, that they are able to maintain the CRAR of 10%. What if a urban cooperative bank is not having the CRAR of 10%? Let's say up to 2.5%. To 50 basis point means 2.5% below the indicator. That means the risk threshold 1 says that the urban cooperative bank is having a risk. Urban cooperative bank is having a risk. When the urban cooperative bank is not able to maintain the minimum CRAR of 10% and the minimum CRAR is up to 2.5% below the 10%. That means if the minimum CRAR is less than 10% till 7.5%. So that is the idea, that up to 2.5%, the UCBs is below the CRAR. Let's say UCB is having 9% of CRAR or UCB is having 8% of the CRAR. So that is up to 2.5%. Up to 2.5%, if the CRAR is below the minimum CRAR, they will come under the risk threshold 1. Let's say that more than 2.5%, that is if the UCBs are having the CRAR of 7%, that is below the 10% minimum, that is below the minimum 10%. By you can understand that is more than 2.5% below the 10% mark. So the UCBs have to maintain the minimum 10% of CRAR, but they are having more than 2.5% below the 10% mark. So more than 2.5% but not exceeding 4%. But not exceeding 4% below the indicator prescribed in that is 10%. Okay. Now in excess to 4%, if your CRAR is below 10%, more than 4%, that is you are even like more than 4% means you are even below 6% mark, you are having 5.5, 5.75% of CRAR. So then you will come under the risk threshold 3. So this is the basic idea. So try to understand that the CRAR minimum regulatory requirement is 10%. If you are having up to 2.5%, below this 10%, then you will come under the risk threshold 1. If you are below this 10% mark, more than 2.5% and less than 4%. If you are below this 10% by more than 2.5% and less than 4%, you will come under the risk threshold 2. If you are having more than 4%, like you are having the CRAR that is lesser than 10% by more than 4%. So that is in excess of 400 that is basic points, that is 4% we can say. So in excess of 4%, you are below the indicator, you are below the 10% mark by more than 4%. So you will come under the risk threshold 3. The higher the risk threshold is, the higher supervisory norms you have to follow, the higher remedial measures you will have to take, the higher restrictions will be imposed on you. That is the basic idea. Got it? Yes. So this is the CRAR requirement. Now coming to the asset quality. Asset quality, that is net non-performing advances. So now coming to the next point, that is asset quality. Asset quality means if your non-performing assets are very low, you are a good UCB. But if your non-performing assets are very high, you are a bad UCB or you are a weak UCB. Okay. So asset quality is seen through the net non-performing asset, that is net non-performing advances ratio. Now the formula has been given for the net non-performing advances ratio, that is percentage of net NPA divided to net advances. Okay. So this is net non-performing advances ratio, that is net NPA divided by the net advances. Okay. So if this ratio is greater than or equal to 6% but less than 9%, you will be under the risk threshold 1. Because your net NPA ratio is greater than or equal to 6% but below 9%, you will be under risk threshold 1. If your NNPA ratio is greater than or equal to 9% but less than 12%, you will be under risk threshold 2. If your NNPA ratio is greater than or equal to 12%, you will be under risk threshold 3. Understood? So this is the asset quality. If your net non-performing asset ratio, that is NNPA ratio, is greater than or equal to 6% but less than 9%, you will be under risk threshold 1. If your NNPA ratio is greater than or equal to 9% but less than 12%, you will be under risk threshold 2. If your NNPA ratio is greater than or equal to 12%, you will be under risk threshold 3. Your urban cooperative bank is very weak then, and you have to follow more supervisory norms. Next is profitability. There should be net profit. So if you are incurring losses during 2 consecutive years, you will be under risk threshold 1. Got it? So there are no further norms that have been given. Directly, if you are incurring losses for 2 consecutive years, you will be under risk threshold 1. Got it? Any confusion till now? Because these are the most important norms that you must know about. Just remember this, percentages that you have to remember, that you have to do. Any confusion now? So I have explained you the norms. Now coming, no confusion, very good, very good. Coming to the mandatory and discretionary action that has to be taken against the UCB. So let's say that the UCB is under risk threshold 1. The urban cooperative bank is under the risk threshold 1. That is, the urban cooperative bank is weak but not very weak. It is on the threshold, on the very threshold level. Okay? Yes. Nice. So risk threshold 1, if our UCB XYZ is under the risk threshold 1, the bank, the urban cooperative bank, has to raise the capital, has to raise more money either from its existing members, existing shareholders, or by issuance of more equity, more shares, and other permissible capital instruments. That is the basic idea, that if you are a urban cooperative bank that do not have the minimum CRAR, that is not following the minimum CRAR, CRAR is near to 10%, but it is not 10%. Okay, if you are having not very good asset quality, if the profitability is not very good, if you are in the risk threshold 1, mandatory action, mandatorily you have to raise the capital first of all. Second is restriction on declaration, payment of dividend or donation. You cannot make donation. You do not have capital for yourself. How are you making the donation? You should not be making the donation. You cannot pay the dividends to your shareholders also, because first of all, maintain your health. Like you have to, how can you give a donation to someone? How can you give blood to someone if you are not healthy yourself? Similarly, you cannot pay donations to anyone if your bank is not healthy. You cannot pay dividends also to your shareholder until you become healthy. So there is restriction on declaration or payment of dividend or donation. So there are restrictions. Maybe you can give dividend, but to a limit only if you are giving. Okay. Appropriate restrictions on capital expenditure other than for technological upgradation. So there is limit also on the capital expenditure. Like if you want to open a new branch, or let's say not a new branch, but you want to have some capital expenditure, machines you want to buy or something. So you cannot do so. Appropriate restriction has been imposed on the capital expenditure other than for technological upgradation. If you are in the risk threshold 2, let's say XYZ bank is a very weak bank, it has got weaker. So in addition to mandatory actions as above, restriction on branch expansion, you cannot expand your branches. Okay, so if you are following in the risk threshold 2, you have to follow all these actions, as well as you have to restrict your branch expansion. Let's say that this XYZ is falling into risk threshold 3. The XYZ will have to follow all these guidelines, all these mandatory actions, as well as appropriate restrictions or prohibition on expansion of total size of the deposits. Your deposits will also be there will be limitations on the deposits that will also be imposed. So this is a very, very strict action that you can see, that appropriate restrictions or prohibition on expansion of total size of deposits. The RBI can say that you cannot take more deposits now. First of all, become healthy, then continue your operations. So these are the mandatory actions that has to be followed as per your risk threshold. Okay. Now there are some discretionary action that the RBI can say that in addition to these actions, you have to follow some other remedial measures also. You have to follow some other actions also. That is written here. Special supervisory actions can be told by the Reserve Bank of India. Strategy related actions can be told by the Reserve Bank of India. Governance related actions can be like UCBs might have to take governance related actions that change your management, revamp your management, have good professionals in your management and such. These are the discretionary actions that you can read. Okay, there were different points that were given in the discretionary action, but they were very theoretical. So if you go through the PDF, like discretionary actions, they are additional actions that the RBI can tell a particular bank to follow. So the PCA framework does not preclude the RBI from taking any other action as it deems fit at any time, in addition to the corrective actions prescribed in the framework. So these are the corrective actions prescribed in the framework. Other than these actions, if the RBI feel that some other action has to be taken, the RBI can do so. So this PCA framework does not preclude. That means this PCA framework cannot stop the RBI from taking the extra actions, from taking the separate actions. Okay. So a bank, a UCB or a urban cooperative bank will generally be placed under PCA framework based on the reported or audited annual financial results of the urban cooperative bank. So urban cooperative bank has submitted a reported financial result, or there is the audit that happened in the urban cooperative bank, and then RBI got to know that okay, the financials of this bank is not very good. So as per the audited annual financial results or reported annual financial results, or RBI was doing supervisory assessment that was made by RBI, or on the basis of any of these reports, any of these assessment, the bank can be placed in the PCA framework under any of the risk threshold as per their financial health. However, RBI may impose PCA on any bank during the course of a year in case the circumstances so warrant. So RBI thinks that okay, this bank is on the verge of becoming a weak urban cooperative bank, so the RBI might impose some restrictions on that bank, and RBI might keep that bank in any of the threshold. Okay. Next is, although supervisory action taken will primarily be based on the criteria that has been given in the PCA framework, but RBI can do any specific restrictions, or RBI can impose additional supervisory actions as per the Reserve Bank of India. Okay. So usually the supervisory action will be primarily taken on the basis of criteria specified under the PCA framework, but RBI has the power to take appropriate supervisory actions. The additional supervisory actions can be taken by the Reserve Bank of India on the basis of the understanding of Reserve Bank of India. And if the RBI thinks that there is some stress that is coming, the stress is noticed in any other important indicator or parameter, or in case of serious governance issues, because governance issues are not directly mentioned here, that okay, if there is governance issues that are coming, then you will come under the risk threshold. But if RBI has the authority that if RBI feels that there is stress that is coming in any different indicator, so RBI can impose some additional supervisory action. So this is on the basis of RBI. Now, how can you exit the PCA framework, or how can you exit the supervisory actions that has been imposed on you? So exit from PCA and withdrawal of restrictions under the PCA can happen on the basis of these parameters. That is, once a bank is placed under the PCA, taking the bank out of PCA framework or withdrawal of restrictions on the PCA, on the bank from the PCA framework, that can be considered when if no breaches in risk threshold in any of the parameters are observed as per the 4 continuous quarterly financial asset. So 4 continuous financial statements that have been given, 4 continuous quarterly financial statements that has been given. As per those 4 continuous financial statements, there is no breach that is happening in any of the threshold. So the bank is following all the thresholds. The bank has started to follow all the thresholds as per the given minimum criteria. So when the bank is following all the thresholds as per the minimum criteria, if no breaches is happening in the risk threshold in any of the parameters that are observed as per 4 continuous quarterly financial statements, one of which should be audited annual financial statement. Why audited? Because how the RBI knows that the bank is saying truth, or the bank is saying the correct parameters, the bank is saying the correct numbers? What if bank is cheating? What if bank is not telling the truth? So That's why at least one of the financial statement out of the 4 financial statements, at least one of the financial statements should be audited from the auditors. So audited annual financial statement should be there. Okay, subject to assessment by the RBI. One of which should be audited annual financial statement, that is subject to assessment by the RBI. So simple, the criteria you have to remember that no breaches in the risk threshold in any of the parameters for the observed as per the 4 continuous quarterly financial statements, one of which should be audited annual financial statement, that is assessed by the Reserve Bank of India. And based on supervisory comfort of RBI, including an assessment on sustainable improvement in key financials of the bank. That is, this you are doing. You are like following the risk thresholds now. You are following the minimum criteria now. But still, if you are following the minimum criteria, but still the RBI is not happy, the RBI is still not satisfied. So RBI can keep you in the PCA framework. So there should be, based on supervisory comfort of the RBI, that the RBI thinks that in the future also you are going to be healthy. It's not like that for the 4 quarters you will say that okay, we are getting healthy and after that you will turn weak again. That should not happen. So RBI will see that okay, RBI is thinking that you are able to maintain your health in the future also, then only the RBI will allow you to get out of the PCA framework. So if you are not making any breaches, as well as if the RBI is thinking that you can maintain this kind of situation where you are not breaching the thresholds, you are not becoming weak again. So when RBI thinks that you are not going to become weak again, then only RBI will take you out of the PCA framework. Got it? Declaration, where is it written? So this was the notification as per the PCA framework, that what is PCA framework, what are the guidelines under the PCA framework. Now the RBI has also released a press release that before the PCA framework there was the supervisory action framework that the urban cooperative banks had to follow. So before the PCA framework there was the supervisory action framework that the urban cooperative banks had to follow. But supervisory action framework, this was very complicated and difficult to understand. That's why the RBI is bringing the PCA framework for UCBs. So before, for UCBs, there was the supervisory action framework. Tier 1 UCBs still have to follow the supervisory action framework. But for Tier 2 to Tier 4 UCBs, the PCA framework has been brought because PCA framework is applicable on NBFCs. PCA framework is applicable on banks like scheduled commercial banks that are regulated by RBI. So RBI is bringing PCA framework for the big UCBs also. So supervisory action framework was followed before by the UCBs, but now Tier 2 to Tier 4 UCBs will follow the PCA framework. Tier 1 UCB will continue following the supervisory action framework for now. Okay. So the salient features of the PCA framework are: the framework has been suitably harmonized with similar frameworks that is applicable for the scheduled commercial bank and NBFCs. So PCA framework is applicable on scheduled commercial bank and NBFCs. So similarly, we have brought a PCA framework for urban cooperative bank also. The PCA framework is largely principle based with fewer number of parameters. So there are only 3 parameters in the PCA framework for urban cooperative bank, while in the SAF, that is supervisory action framework, there were number of parameters that were very difficult to comply with. Okay, so PCA framework is largely principle based, that is with fewer number of parameters as compared to the supervisory action framework, without any dilution in the supervisory rigor. So PCA framework has fewer number of parameters, but still there is no breach that is happening in the supervisory rigor. Okay, that is supervision is still very strong in the PCA framework, even though it has fewer number of parameters. The revised framework seeks to provide, so PCA framework seeks to provide flexibility to design entity-specific supervisory action plans based on the assessment of the risk. So here you can see that there are different discretionary actions that can be taken by the RBI. So let's say that a bank is not having good governance. So governance related discretionary action can be taken. The bank is a good bank, very good governance, very good professionals that are working in the bank, but the strategy is wrong. So strategy related discretionary action can be taken. Okay, credit credit risk related actions can be taken. So on the basis of the bank and on the basis of the problem that is being faced by the bank, different actions can be taken. So that is the idea under the PCA framework. There is flexibility to design the entity specific supervisory action as required by the entity. Okay. The hard-coded limit of rupees 25,000 for restriction on capital expenditure has been removed. So there is no limit that has been given. Appropriate limit will be told on the capital expenditure as per the different banks. Okay. So there is no one limit that is provided. There is any limit can be followed. So in the SAF framework, in the supervisory action framework, there was one limit that was told that the capital expenditure limit is this. But under the PCA framework, because different banks have different money requirement and such, so different banks will have different capital expenditure limit. Okay, so a single limit has not been told. The PCA framework has been made applicable to all the urban cooperative banks that are in tier 2 to tier 4 except the UCBs that are under the all-inclusive directions. So for tier 1 UCBs, still the SAF framework is going to work. Okay. Tier 1 UCBs have been excluded from the PCA framework for the present. However, they shall continue to be subjected to enhanced monitoring under the existing supervisory framework. So they are under the supervisory framework. The revised framework is expected, the PCA framework is expected to give more focus on the larger UCBs. That's why the PCA framework is for the tier 2 to tier 4, requiring more intensive monitoring by the optimal utilization of the supervisory resources. Any confusion till now? SAF is similar to PCA framework. There also there are criterias, but SAF is like, it was having a lot of guidelines and different guidelines. Okay, so it was more complicated, we can say, in understanding. Okay. Yes, Titanium. Yes, the PDF will be provided to you in Telegram channel. So someone was talking about declaration, restrictions on declaration for risk threshold 1 category. Declaration means, okay, declaration means that how much payments you will make. So there are restrictions that you cannot declare your payment just like that. First of all, like you have to limit your dividends that you are giving, you have to restrict your donations that you are giving. So any declaration that you will give this much amount to a single entity, so that has to be also limited. Okay, that has to be restricted also. So now this is the first question. I hope you will be easily able to solve this question. Now before going to the second question, I want to show you that the EduTap has brought for you edutap.co.in. This is the website where you can get the exam related information. So if you want to know about any particular examination, okay, so you can go to this website. There is the free material that is provided to you. So you just have to type edutap.co.in and you can go to this website, and here under the free material there is the blogs that is provided to you. Okay. So there is some problem in the internet, I guess. Yes. So you can go to the free material and you can go to the blog section. So in the edutap.co.in free material blog section, and if you want to get more information about the RBI grade B, about any particular examination, so you can explore by topic and you can have the exam information for any particular examination. Let's say RBI grade B you want to know about. So you can go for the RBI grade B and you can know about the examination. Okay. So there are various things that have been added here: ESI syllabus, phase 2 pattern, the FM syllabus, the sectional timing and such. So you can know more about the examination. If you want to know about the strategy, you can know more about the strategy also that you have to follow for different components. If you want to know about the strategy that has been followed by the toppers, so you can read the blogs here that have been very detailed, in a detailed manner they are explaining you the things. Okay, so this is it. If you want to know about the courses, you can go to courses section and you can know about the courses for any particular examination. Okay, and what off you are getting, everything is mentioned here. So now I hope you will be easily able to answer this first question. Now coming to the second question. So this is your second question. Again, I hope you will be easily able to answer this question. Whether following Just a second. You're most welcome, Ritika. Yes, Kiranshi, whether following these finance classes for GA taken by you from... See, nothing is enough, okay? Usually nothing is enough in the RBI Grade B examination. So if you have any course, you can follow that course, the PDFs from that course. The videos are taken for you. The videos that we are doing, this is taken for you to understand the important and the difficult notification. So I'm bringing the important and the difficult notification that you can understand. If you have any course, go through the PDFs that have been provided by that course. If you do not have any course, go through the RBI website. How you have to go through the RBI website? A video has been made on that also. Okay. So the videos are here for you to understand the difficult notifications or the very important notification. So that I'm trying to bring for you. You're most welcome, Priya. Thank you for wonderful comments. So thank you, everyone. I think everything is clear. So do tell me the right answer of the homework question, the first one and the second one. Do tell me the right answer of these questions, and thank you very much. If you have any query, you can comment down below. Do tell me the right answer of the homework question. So this is it from my side. Thank you very much, everyone. Thank you.